Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner with our March monthly market update, coming to you a little sooner than normal to address everything that's going on, including geopolitical events. Again, we hope this note finds you well. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you next month. Invitations will be going out soon at our quarterly investment forum late April. We hope to have over 100 attending, so look for those invitations in the very near future, where we'll be discussing all of these things in more detail. So a lot going on. We'll kind of jump right in. One of the pieces that we shared in our February monthly market update was kind of a moving towards the possibility of greater geopolitical risk. Well, part of this has been answered in the what will happen has happened. And we'll talk about that more in a second, in terms of what we're kind of following, what could happen and what the market is priced in. So we're now in the second week of the military action in Iran. It's obviously having dramatic impacts on oil markets and risk assets overall. In fact, we saw WTI trade over the weekend in the 110 range. We're now seeing it at about 100, but WTI up 36% for the week, while Brent was up 27. So clearly, as it relates to 20% of all oil going through the Strait of Hormuz, there's a significant expected impact of that. And oil is, no surprise, is getting traded in a volatile way. So where that winds up settling, we'll see. But clearly, it's having an impact, and it's having an impact greater in risk assets. So we saw the lowest point reached since mid-December last week. And we're about 3.5% to 4% as of the opening close on Monday from all-time highs from late January of this year. So clearly a lot going on, a lot of volatility. One of the things that's interesting is to zoom out and look at perspective when there's other geopolitical events going back to 1962. So 13 of them. On average, the yellow represents the days to bottom, and then the red are days to recovery. And kind of what this shows is the median or the midpoint of these 13 events is 14 days till we're back to where we were before the market sell-off. And only 3 of these scenarios do you have, much more than a 25-day to recovery. So again, something to keep an eye on. And just to zoom out, what has happened in other geopolitical events going back to 1962. And just more broadly, for whatever reason, if markets go down over a day, month, or 3 months, kind of on average, what the return is 1 year later, 31%, 23, and 28.5, going back to 1950. So again, this just says that, market timing and volatility are kind of hard to do and to get right. And what's supportive of markets, whether it's marking a bad day, bad month, or a bad 3 months, is that the return 1 year later in broad markets is on average much higher. So again, back to where we started on geopolitical risk, what will happen? We know that with Epic Fury now being in its second week, we know at least the starting of what will happen because it's in motion at present. What could happen, remains to be seen, and then what the market is priced in. So the market's priced in and is pricing in, the predicted whether this conflict is going to be short-term or long-term, to what effect oil prices are trying to price that in. So again, these are things to keep an eye on. We never know with a geopolitical event like this what the market is priced in. So all of those are worth keeping a very close eye on. And there's other things to follow and pay attention to. The February jobs report was not good. Loss of 92,000, or over 50,000 to the plus side was what was expected. Unemployment rate ticked up to 4.4, and 12-month average hourly earnings was up just under 4%. The first rate cut by the Fed, which will be under new leadership by this time, is expected to be in July. The Fed meets next week, and so their comments will be relevant, but they're not expected to cut next week. We're not expecting a Fed cut until after the new chair is in, and that'll be in May if approved. And the markets are at this point not pricing in a rate cut until mid-year. So the CPI, the most recent one, was 2.4, which was less than expected. So that was positive. Next CPI report comes out this Wednesday. We'll see. So we'll see if this trend continues. One of the concerning things on inflation is that wholesale inflation spiked up a little bit recently. So 0.8 in January, which was a lot more than expected. So something else we're keeping an eye on. And one of the things we're keeping a close eye on is earnings, which have been very good in the last few years, and to see if that continues. For Q1 of 2026, earnings growth is expected to be at 11.5% year over year. So far this year, the roughly 100 companies that have reported, 46 have given negative EPS forward guidance and 56 have been positive. So again, earnings and those continuing to be strong is something that we're following very closely. And as it relates to the top of the market, which we've talked a lot about, how top heavy the S&P is, and whether or not the market cap is justified by earnings. This is another way to think about that. The weight in the top 10 companies in the S&P 500 are 40%, just under, and the top 10 earnings, and that's come down a little bit the first part of this year. The earnings are about 33%. So what that shows is that at present, the market cap is being justified by share of earnings. And in fact, we saw an interesting phenomenon in 2025 where we started with tech companies having a 29 forward PE. And because the earnings were so good in 2025, the stocks actually got cheaper, trading at 26 times forward earnings by the time we got into December. So you had an interesting phenomenon where even though the price went up, valuations got better because the earnings were so strong. We are in, as we kind of approach midterms in the back half of the year, year two, compared to other presidential years, are lower and more volatility than in others. So again, this goes back to 1950, average midterm year up 4.6 with a drawdown of negative 17.5. So we still have the issue of a lot of cash on the sidelines, so just under 8 trillion of money market assets. When you have that dynamic, it tends to be supportive of stocks. The time that cash has peaked in other cycles, on average, stocks are up 16, 19, and 13. So that tends to be supportive of stocks when you have a money market or cash weight like you have now. And this is just a reminder of where we are in the current bull market that ended in Q4 of 2022. It's up about 93% as of the end of 2025, and the length of time is 39 months. On average, the bull market is 192, and for about a 5.5 year period of time. So by historical measures, we're about halfway in duration and about halfway in terms of total return of the average bull market. And this is just zooming out even further as we kind of think through the volatility that we're experiencing and that is always painful to go through. And that's zooming out 100 years of markets, and the 74 of those 100 that were up and the 26 of those 100 that were down. And every down year is a painful year to go through. But overwhelmingly, both in frequency, 74 out of 100, and in momentum, the average return on the upside year, 21.5% versus negative 13.5%. To the downside, that both the momentum in terms of percentage of time the markets are up, and then when they're up by an almost 2-to-1 margin more than they're down. Doesn't make these negative years not painful to go through. They are, and this current volatility is tough to go through. But it does just kind of as a zoom out reminds you of context going back 100 years in the markets. We will be rebalancing in the coming weeks to address market changes and where we think there's opportunities, and we'll send trade notes out in advance of that. So none of this is a replacement to contact us directly about any questions you have, any concerns you have, discuss how all of these things apply to you. We're here to serve you. We hope to see many of you. Again, invitations out soon, late April of just next month now. We hope to see many of you at our quarterly investment forum. Again, look for those invitations very soon. So with that in mind, we will close. Again, thank you for the trust and confidence that you place in us. Please reach out to us if we can help in any way. Until we see you again, either in our office on a Zoom call or hopefully at our quarterly investment forum next month, be well and take care.